Welcome back to the deep dive. Today, we're taking a truly foundational look, really getting into the world of accounting. Now, you might think, okay, accounting, numbers, but our mission here is, well, it's to uncover those deeper insights, the aha moments that really show you how this language of business actually works. We're definitely going beyond just definitions today. We're going to explore that fascinating interplay of transactions, the bedrock accounting equation, how T accounts act as these visual trackers, the sort of art of journal entries, the mechanics of posting, and then how it all kind of culminates in that vital snapshot, the trial balance. It's really a complete journey showing why these core concepts are just so powerful. But before we dive deeper, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, examples, explanations we're discussing, they're derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or already a professional, definitely visit the website. They've got additional practice questions, video lectures, detailed support, to really reinforce today's topic. And a special thanks to Professor Farhat for providing this valuable material for us to dig into. Okay, so let's talk about the absolute bedrock. The transaction, we use that word all the time, right? But in accounting, it's way more precise. What exactly defines an accounting transaction? And what's that core principle, the thing that makes it so robust?
Right. Well, in accounting, a transaction isn't just, cash changing hands. It's really any financial event that impacts a company's assets, its liabilities, or its stockholders' equity. And the real genius here, the absolute cornerstone of the whole system, is this dual effect principle. Every single transaction, no exceptions, touches at least two accounts. And this isn't just some arbitrary rule, it's like a built-in error detector.
That's it. It's what drives the whole double entry accounting system, isn't it? So if every transaction has this dual effect, one side debits, the other credits, what does that ultimately ensure for our financial records?
It ensures that your total debits will always equal your total credits. Always. Think of it like an unbreakable financial balance beam. If you put a debit on one side, there must be a corresponding credit of the exact same amount somewhere else. And that consistency, well, it means you have an immediate internal check on accuracy. Super crucial for catching errors and, giving you that audit trail.
Right, right. And all of that dual effect business, it ultimately feeds into what people often call the grand equation of accounting. How does that simple formula really capture a company's financial standing at any point in time?
Yeah, the entire financial reporting system really hinges on this one deceptively simple equation: assets, liabilities, plus owner's equity.
Yeah.
But it's more than just a formula, right? It's like a constant statement, an affirmation of that financial balance.
Okay, so can you quickly break down what each of those pieces represents? Maybe give us a quick, relatable way to think about them.
Absolutely. So assets, that's everything a business owns that has future economic value. Think cash, supplies on hand, equipment, even money customers owe you accounts receivable. They're basically resources that help the business operate and generate future income. Liabilities, that's pretty straightforward. It's what the business owes to others. Debts, obligations, like a bank loan or money owed to suppliers, that's accounts payable. And then owner's equity, sometimes called net worth or residual interest, that's what's left for the owners after all the liabilities are paid off. It's the owner's claim on the assets. And the reason this equation must always stay in balance is because every transaction, it just rearranges these pieces or maybe expands them, but it never disrupts that fundamental equilibrium. If it doesn't balance, you know something's gone wrong.
Yeah, it's fascinating how all those different account types, cash, accounts payable, equipment, they all slot into just those three categories, constantly shifting but keeping that balance. Okay, so we understand the transaction, its impact on the equation. How do we actually track the changes within each specific account? That's the T account, right?
That's right. T accounts are really your fundamental bookkeeping tool. Simple but powerful. They're called T accounts just because they visually look like a capital T.
Right.
Creates two distinct sides. The left side is always the debit side, and the right side is always the credit side. And this simple structure, it just lets us track the increases and decreases within every single individual account.
Okay, debits and credits. They can be a little counterintuitive at first, can't they? Because they don't always mean plus or minus in the way we normally think. Is there a simple rule of thumb? Or maybe a common pitfall people stumble over when they're trying to get a handle on them?
Yeah, it trips people up sometimes. A great way to remember how debits and credits work for different accounts is a simple mnemonic: DEA LOR. DEA LOR. So DEA, that stands for debits increase, expenses, assets, and dividends. For those accounts, a debit makes them go up and a credit makes them go down. Simple as that. Then LOR, That's for liabilities, owner's equity, and revenue. These all increase with the credit. And logically, they decrease with the debit. The other key thing is understanding an account's normal balance, which is just the side, debit or credit, where it normally increases. Like cash is an asset, so its normal balance is a debit. Honestly, most of the errors you see, they come from not consistently applying these rules, which throws the whole equation out of whack.
DEA lore. Okay, got it.
Yeah.
So we've identified the event, we see its impact on the equation, we know T counts track the individual changes. Now, how do we start to formally record these things? To create that chronological story, that financial diary of the business.
That's where your journal entries come in. They're essential. A journal entry is basically your first official record of a transaction. You list them chronologically in what's called a journal, or more formally, the general journal.
Yeah.
Format's important. You always list the account being debited first, then the account being credited is listed below it, slightly indented, and of course the amounts go alongside. It really acts as this meticulous date-stamped diary of every single financial event.
Okay, so we craft that journal entry. Then what? What's the critical next step to make sure our actual account balances, like in the T accounts, get updated?
Right, you then have to post that entry. Post it to the general ledger. Think of the general ledger as like the master file, the big collection of all your individual T accounts, one for cash, one for accounts payable, one for revenue, everything. Posting just means taking the debits and credits from your journal entry and transferring them over to the correct T account in the ledger. That's how you keep a running, up-to-date balance for every single account. It's the step that takes all those individual diary entries and aggregates them, giving you that clear, current snapshot for each account.
Okay, makes sense. Journalize first, then post. So after all that recording and posting for a period, how do we get that consolidated view, that bird's eye look at all our accounts and their balances just to check if everything is still, singing in harmony before we move on?
That's exactly the job of the unadjusted trial balance. Key word there is unadjusted. It's basically a preliminary list. It shows every single account in your general ledger and what its ending balance is at that point in time. And crucially, it's prepared before any of those end-of-period adjustments are made. Think of it as your first big diagnostic check in the accounting cycle.
And what does that trial balance actually reveal to us? Beyond just being a list of numbers, what's the critical check it provides?
Well, it organizes the accounts logically, usually assets first, then your liabilities and equity, then revenues, and finally expenses. That order matters. And each account is listed with its normal balance. So all the accounts with debit balances are in one column, all the credit balances in another. And here's the crucial part, its primary purpose, really. The total of that debit column must equal the total of that credit column. If they don't match, boom, you know you've got an error somewhere, maybe in journalizing, maybe in posting. You've got to go back and find it. Now, it won't catch every possible error, like if you debited the wrong asset account, but still debited an asset. But a balanced trial balance gives you good confidence that the basic mechanics, that dual entry system, have been followed correctly. It's really the foundational document that sets you up for the next steps, like making adjustments and preparing the actual financial statements.
Okay, this is where it gets really interesting, I think. Let's actually bring all these pieces together, walk through a few common real-world examples. Let's imagine Adam is starting his new consulting firm. Example 1, owner investment, host speaker. Okay, first thing. Adam invests $50,000 cash to kickstart his consulting firm. In return, he gets common stock. How do we make sense of this accounting-wise? Expert speaker. Okay, this immediately hits two accounts. First, cash, which is an asset of the business, increases by $50,000. Expert speaker. And second, common stock, which represents Addie's investment and is part of stockholders' equity, also increases by $50,000. Expert speaker. So look at the equation. Assets went up $50K, equity went up $50K. Assets, liabilities, plus stockholders' equity. Perfectly balanced. Host speaker. Right, so the journal entry would be debit cash, $50,000, expert speaker. Because cash is increasing and it's an asset, yep, host speaker. And credit common stock, $50,000, expert speaker, exactly. Because equity is increasing and equity increases with a credit, then you'd post those. The cash T account goes up, the common stock T account goes up, expert speaker. And this really highlights that key idea. The business is separate from the owner, even if it's just Adam starting out. Example 2, purchasing equipment with cash, host speaker. Okay, next up. Adam's company buys $9,000 worth of computer equipment, pays cash. How does this transaction kind of shift things around? Expert speaker. Right, so here you're basically just swapping one asset for another. Cash, which is an asset, decreases by $9,000, expert speaker. But computer equipment, which is also an asset, increases by $9,000. Expert speaker. So notice the total amount of assets hasn't actually changed. One went down, one went up by the same amount. So the overall accounting equation, A ball plus SE, stays perfectly in balance. Host speaker. Got it. So the journal entry. Debit computer equipment, $9,000. Expert speaker. Increasing that asset. Host speaker dot at and credit cash, $9,000. Expert speaker. Decreasing that asset. Yep. And when you post it, the cash T account balance drops while the computer equipment T account balance goes up. It's a really common internal shift you see within the asset category. Example 3, borrowing from a bank. Host speaker. All right, Adam needs a bit more capital. His firm borrows $40,000 from a bank, signs a note payable. What's the dual impact here? Expert speaker. Okay, so this brings in new resources, but it also creates a new obligation. Cash, an asset, goes up by $40,000 because the company gets the money. Expert speaker. But at the same time, notes payable, which is a liability, also goes up by $40,000. The company now owes the bank that amount. Expert speaker. See how both sides of the equation increase? Assets up by 40K, liabilities up by 40K, balance maintained. Host speaker. Okay, so journal entry. Debit cash, $40,000. Expert speaker. Cash increase. Host speaker dot dot dot. And credit notes pickle for expert speaker. Liability increase. Correct. Posting updates both those T accounts, showing the immediate cash inflow and the corresponding debt. Example 4. Performing services on account. Host speaker. Okay, now, Adam's firm performed $10,000 worth of consulting services for, say, Robot Inc. But here's the key. It's on account. Robot Inc. hasn't paid yet. This happens all the time, right? How do we record that? Expert speaker. Yes, very common. This is classic accrual accounting in action. Because Robot Inc. owes the firm money now, accounts receivable, which is an asset, goes up by $10,000. We have a claim to that cash. Expert speaker. And critically, even though no cash came in yet, the service was performed. So consulting revenue, which increases stockholders' equity, also goes up to $10,000. You've earned it. Expert speaker. Again, assets up $10, equity up $10. Balanced. Host speaker. Right, you earned it even if you haven't collected it. So debit accounts receivable $10,000. Expert speaker, the asset increase. Host speaker data and credit consulting revenue $10,000. Expert speaker. The revenue, which increases equity. Exactly. Posting updates both those T accounts, clearly showing money owed to us and the revenue we've generated. Example 5. Receiving cash for future services. Unearned revenue. Host speaker. Okay, here's a slightly trickier one maybe. Another company, let's say Automation, pays Adam's firm $4,000 today, but it's for consulting services that Adam will perform over the next 2 months. So it's paid in advance. What happens now? Cash came in, but the work isn't done.
Expert speaker. Ah, yes, this is a key distinction. Really important concept.
Cash, the asset, definitely goes up by $4,000. The money is in the bank. Expert speaker. But because Adam hasn't actually earned that revenue yet, he still has an obligation. He owes Automation those services. This creates a liability. It's called unearned revenue. Expert speaker. That unearned revenue account also goes up by $4,000. The company essentially owes a service now. Not money, but it's still an obligation. Host speaker. Oh, okay. So it's a liability because you owe them the work. Got it. So debit cash, $4,000. Expert speaker. Asset increase. Host speaker now and credit unearned revenue $4,000. Expert speaker liability increase. Precisely. The cash T account goes up, and this new liability account, unearned revenue, appears on the books, showing that future obligation. This is often a conceptual hurdle for people starting out, but it perfectly illustrates that obligation principle in accounting. Wow, yeah, these examples really grind home, don't they? You can see how each transaction, no matter the specifics, it consistently impacts at least 2 accounts. It rigidly maintains that accounting equation, A plus SE, and gets meticulously recorded through those journal entries and then posting to the ledger. It's really, it's quite an elegant system when you see it in action. The systematic way to tell the business's financial story. So we've really covered a lot of ground today, haven't we? Gone on a proper deep dive uncovering the foundational mechanics of the whole accounting cycle. From really decoding what a transaction is in this context to understanding how every single entry flows through and culminates in that perfectly balanced trial balance. Hopefully you now have a much clearer, maybe more nuanced picture of how businesses track their financial story.
And that's exactly the point, isn't it? Mastering these basics, it isn't just about memorizing definitions or rules. It's really about understanding the underlying logic, the discipline that makes financial information reliable. This deep dive, hopefully, has equipped you with the tools to critically assess those fundamental movements, those ebbs and flows, within any business's financial life.
So what does all this mean for you, listening in, now that you've seen that dual effect in action, how every financial event leaves its undeniable fingerprint? How might you start to view maybe your own everyday transactions or perhaps the financial news you've come across a bit differently? What stands out to you from today? Was there a particularly surprising or maybe useful nugget from this discussion? Something to chew on.
Well, we certainly hope this deep dive has provided some valuable insights. Remember, building this strong foundation in accounting, it's absolutely key to future success. Doesn't matter if you're a student just starting, a CPA candidate, deep in study mode, or even a seasoned professional just looking to sharpen that understanding. And for those additional practice questions, the video lectures, more detailed support to really reinforce these topics and maybe explore even further, we definitely encourage you again to visit farhatlectures.com. Invest in yourself, invest in your career. Good luck on your continued learning journey.